Hi, this is Brenna Surette, Wealth Advisor at Brenna Wealth Management, and today I'm joined with Adam Newman, Senior Wealth Advisor and Managing Partner on the team. Welcome to Byte Size Retirement, where we take common retirement planning topics and break them down into bite-sized pieces. These videos are not tax or investment advice, but hopefully serve as a strong foundation to build off of. And while we're taking just a few minutes to discuss these topics, please take more than just a few minutes to make any of these important financial decisions. So with that, today's topic is all around qualifying for the Affordable Care Act tax subsidies. So Adam, I'll actually pass it off to you to kick this one off. Do you want to just explain generally how these subsidies work?
Yeah, so just to kick it off, the health exchange is there and was created as a result of the Affordable Care Act to help Americans access reasonably cost health insurance, and specifically as it pertains to retirement. This is a medium that a lot of us might need to access if we don't have coverage through an employer plan or a spouse's plan. And so the exchange is there, and it's very state specific, and even beyond that, zip code specific, and it gives early retirees, those before Medicare age 65, the opportunity to buy insurance and select from a handful of different insurers and different plans through the exchange. So you'll notice as you go through, if you go to healthcare.gov, you select see plans and prices. You'll put in some information such as your age, your zip code, and basic family demographic information, and then it'll spit out a bunch of different plan options for you and the various monthly cost of each plan. So, and what a lot of people don't know is this number, this per month cost for a plan is incredibly variable depending upon your income. So the way that works is you put in an estimated income number into this questionnaire, and you're guessing. You're not sure what your year's going to look like yet, but you're putting in a number based on your best guess, and the price that is generated is based on that income estimate. And then when it comes to tax time, you'll either owe additional money or you'll get some credits that some tax credits back, depending on if your income was higher than lower than you thought it would be. So just go in and see for yourself, play around with different income numbers, and you'll notice some really wildly different, plan costs. And so a big planning opportunity we want to emphasize today is, how to manage around that and how to take advantage of that if you're in a position to. So while we do that, Brenna, focusing specifically on that income estimate number, how is that generated? What goes into it? And what are some things we might want to think about when estimating that income?
Mm-hmm. Yeah, so the income calculation is based on your modified adjusted gross income. And what that is your adjusted gross income plus certain items such as tax exempt bond interest or tax exempt Social Security benefits. But the real big job, sort of what you were hinting at, is determining what that number is for the year projecting out, since we know that no 2 years are the same and life's always changing. So it's helpful to sort of look at last year's income as a starting point and a launching point, but then considering, what's changed for the year. Did you get a raise? Did you get a new job? Any changes in dependents, anything that might impact your income projections. So that's kind of the income calculation in a nutshell, but I'll pass it back to you, Adam. Could you explain, what are some other unique considerations when picking a marketplace healthcare plan?
Yeah, I think the big thing for retirees to understand is that this is a really big planning opportunity. So part of what you need to plan ahead for is, can I control my income? Knowing what I know, about what I have coming in as a retiree, are there things I can do to find that sweet spot in my income level to where I can qualify for the largest amount of tax subsidies, but also, be on track for my plan and have enough, sufficient income to live off of. So, some of the things you really might want to consider is, where are you withdrawing your retirement income from? So are you pulling from taxable brokerage accounts or pre-tax IRAs or Roth IRAs? So where you're pulling that monthly retirement paycheck from, so to speak, might be a really big input there. And the other might be, how are you managing and making decisions within your portfolio? One of the things we like to do is, again, plan ahead and make sure that we don't need to be incurring substantial capital gains or taxable activity early on, before someone hits Medicare age and they need to qualify for these subsidies. We want to manage that tax situation in the portfolio to make sure we're as efficient as possible. So just, really from an income generation standpoint, are there things you have control over? And I understand that, there might be cases where you've got large pensions or other things happening that are out of your hands, and that's fine. That's part of, the way, retirement unfolds in some cases. But for the things you can control, knowing the planning opportunity exists and being proactive about it is really important. The second is, especially when you're retiring early and you consider yourself to be young and active, and you don't really access the healthcare system for a whole lot of needs, then you would, might want to consider leaning in the direction of going with the higher deductible plan, which is lower cost in its nature, but also pairing that with annual contributions to a health savings account. And we did a whole other video on HSAs and why they're so beneficial long-term from a planning standpoint. But a lot of retirees don't know that even though they're not working anymore and they don't have income, they can still continue to contribute to HSAs up until age 65. So for those that are young and active and healthy, that's a really a great combination to consider. And then, finally, there is such thing as income that's too low. So a lot of times when people research these subsidies, they say, well, I'll just live off my checking account and my income will be zero, and then I'll qualify for all these subsidies. Unfortunately, that's not the way it's worked. There is such thing as too low of income, and it really is a sweet spot, as I referenced earlier. So the negative of having income that's too low is, depending on your zip code and your state, you might be pushed off the exchange and into Medicaid. So, and the easiest way to determine this is go through that calculator on healthcare.gov and put in your zip code and play around with a really low income number. And you'll notice at certain breakpoints, it starts saying, hey, you can't access these plans anymore. You need to go and enroll through the Medicaid system, which is, if we have a choice, we're not going to want to do that, right? We want to have control and be empowered in making our healthcare decisions. So just be aware that that's there, and it's something to think about. And there's actually clients where we have to force and generate income up to that, that floor amount to make sure that they don't get pushed into Medicaid. So it's almost like a sandwich zone, right? Your income's too high, you don't get the subsidies. Your income's too low, then you're on Medicaid. So it's a Goldilocks kind of scenario you're planning for. And these numbers and these subsidies and breakpoints do change year over year. So it's an annual conversation you want to be having. And these, if used correctly, planning around these subsidies can be incredibly valuable, especially for those that are concerned about healthcare costs in retirement. So we hope you found this beneficial, and appreciate you tuning in. If you've got any other retirement planning questions or topics you'd like us to address in a future video, please feel free to leave those down in the comment section below. And thanks again.